So, what is the differences between realized and unrealized P&L? First of all, realized P&L is profit or loss where the position has been closed out, and therefore the profit or loss in cash terms is known with complete certainty. In accounting terms, realized P&L refer to profits or losses from completed transactions. On the other hand, unrealized P&L is profit or loss where the position has not been closed out. Therefore, the P&L is based on estimates of the amount that would have been received should the position be closed out. In accounting terms, unrealized P&L refer to profits or losses that have occurred on paper, but the relevant transaction have not been completed yet. Let's take an example. Let's say a trader bought shares for $50. 1 month later, the shares are trading at 55. If the trader chooses to sell the shares, he will receive 55 in cash. Since the shares will actually have been sold, the trader will have earned a realized profit of $5 over the month. On the other hand, if the trader chooses to hold the shares rather than sell them, he will have earned an unrealized profit of $5 over the month. The profit is unrealized as the trader still holds the shares in his portfolio. It can get a bit more complicated as we come to different financial instruments classification. For example, let's use government bonds as an example. In the first scenario, the desk intention is to buy and sell the bond as a market maker. Therefore, the bond will be classified as held for trading. So before the desk selling the bonds, the unrealized gains will be recognized in the income statement. In the second scenario, the desk intention is to sell before the bond reach their maturity, and therefore by accounting standard, they will be classified as AFS, so that's available for sale, and they are reported at fair value. Before selling the AFS, the unrealized gains or losses will be recognized in the accumulated other comprehensive income, so OCI, which is within the equity section of the balance sheet. The financial classification for a bond as a held for trading or as a AFS is required by accounting standard IFRS9, and we can link this concept to understand the SVB event that happened earlier this year. By 2022, as shown in this graph, SVB owns $26 billion securities as AFS. From an accounting point of view, the market value changes of the AFS or the unrealized gains or losses is not recognized in the income statement, but under OCI. But the danger of this in the SVB case was that when they were forced to sell the AFS securities, they had to realize the significant losses. Thanks for watching, and I will see you in the next session.